try to get back into it because I know we touched on it briefly. That was the number 2 question I had. What's going on with mortgage insurers? What can we do? How do we get around that? What's it all about? How do the policies vary? How does that all come into play? And what strategies are there to getting around or defeating it, getting your short sale approved? So you could touch a bit on the mortgage insurance, and I'll gladly say what we've done with regard to mortgage insurance. I shouldn't say it's been effective all the time, but it's worked in some cases. So.
Sure. As I said, when these MBSs are formed, they have to be rated back at Moody's or Standard & Poor's, and there's an evaluation done of what these loans are configured and how they're put together and relative risks. And mortgage insurance is generally a hedge bet, and it's a hedging device to offset, to minimize, if you will, potential losses on a particular loan defaulting. Okay, so that's why you buy insurance. When you issue this loan to this borrower, it's an 80-20 piggyback, hence there's a higher risk of default. We're 100% loan to value. So that has, if the investor were looking at loans, would say there's a higher risk there. I'm not going to be willing to pay as much for that loan as I would if it were an 80-20, right, with the 20 being cash, because of the value of the asset. So the insurance is designed, to offset part of that and to enhance the value of the loan. Why? For value in that equation. For the value add to be able to compile those loans into more and more and more MBSs. Because at the end of the day, the lenders didn't make money on one-off loans. These loan origination fees pale in comparison to the fees that they get when they take these pools to Wall Street and securitize them. That's a lot of money. Okay? So the exercise was this. I can either originate a whole bunch of loans and get paid a little percentage, or I can fill up a whole bunch of pools and take it to Wall Street and get paid a lot of money. Now, if I need $500 million in face value of loans, what's easier to fill? With a bunch of $100,000 loans or $500,000 loans? Okay. How do I get to $500,000 loans? Because these borrowers can't qualify. Well, I know what. We'll throw out all these loan products like liar loans, state of income, no doc, all the rest. But in order to get them rated, okay, in order to pass the smells good test, okay, I need to do things like get MI, because it's 100% financing. But if I can do all this, get these pools filled up, get enough pools up there, I'll make more and more and more and more money. So back to the end here. We've got a loan down here that's 100% financing, but if you put PMI on it, okay, it enhances the value of that loan. And now it goes in here and these guys can get more and more and more money for it. What the PMI is designed to do is you've got a loan amount here of $200,000 on that loan. And then if you have a default, you're going to get what? The asset back, which is the property under the deed of trust. But what's the value? We don't know. Think of this as gap insurance, right? Because there's that gap. If there's a default, the lender has to take the property back and sell it, typically. And that will derive a price of less than what is owed. So the insurance is designed to cover that gap. And the way that it works mechanically is not unlike your auto insurance policy. That if you're driving along and someone hits you from behind and damages your car, and you want that covered, you have to tender that claim to your carrier, right? And that policy says that they have the right to control the final resolution of that claim. You got to do a lot of legwork yourself, but there can be no settlement of that claim without their approval. And if you do settle it, you void the coverage and you don't get paid anything by the insurance company, Allstate or anybody. Same mechanical process. So when the note defaults, if there's PMI on it, the lender will tender it to Radian, Genworth, and the other carriers. Then they go through the exercise, okay, of the short sale, the loss fit package, everything else, to determine what the value is here. But at the end of that process, and this is where it gets to Brian's question, before that short sale offer can be approved, it needs to go upstream to the MI company for final approval. Why? Because there's going to be a loss on this particular loan, and the lender's looking at recovering that loss payment on that gap. Okay? So not unlike the guy that hits you from behind says, I'll tell you what, you've got $2,500 damage to your car, and don't report it, I'll pay you $2,000. If you take it, you're screwed. Right? Your carrier's not going to pay you the difference. You can get paid the $2,500 to repair your car from your carrier, and your carrier has a right of subrogation to go sue the guy that hit you. Right? So it generally works along the same lines. Now, the same problem occurs here in the real estate world as it does in other areas of insurance. Insurance companies generally have a pretty straightforward equation to profitability. Maximize premiums, minimize claims, X less Y equals Z, which is profit. And they're in the business of making profit. Right? They collect premiums based upon a risk assessment, statistical data analysis, and it's gambling, legalized gambling. They're betting. When they placed all these bets and they collected premiums on these particular loans, they had no idea of what was going to happen to the market. So they woefully, woefully, woefully underestimated the risk. The premiums were abnormally low compared to the real risk. And now, you know, those chickens have come home to roost, and the losses are exponentially greater than what they had calculated. The way they pay for losses, they take the premiums and they invest them. They buy all sorts of things. How do you think Desert Highlands was built? Through insurance money. They invest in all sorts of projects, locally, nationally, internationally. They make a lot of money. All right? That's how they're paying for these claims, and not just through premium. So their idea is, and this is my direct conversation with Radian in a screaming match with Radian on mitigating loss. Because a year ago, short sales would gather you 25 to 30 to 35% higher return on the asset than a trustee sale. My argument was that everybody in the equation had the legal obligation and duty to minimize or mitigate their loss. And therefore, Radian, by making an arbitrary demand of $75,000, you've heard those numbers tossed around before, haven't you? On a note from the borrower as a condition precedent in closing the short sales, was exacerbating or making the situation worse. Because otherwise it goes to trustee sale, thus increasing the gap, increasing the amount of coverage and the loss of payment that has to be made. The answer at the end of the day was, yeah, I know, Neil, and I really don't care, because we know we're going to have to pay a loss on this claim, on this file, but if we have to pay any, whether it's more or less, we'd rather pay it later than sooner.
And they still have that philosophy? That's still their philosophy?
They are trying to push off the losses as much as possible. Of all the players in the game, all the players that are involved in this whole industry, the PMI companies are suffering perhaps the greatest loss, because it's a form of a gamble, and they just woefully underestimated. So the premiums they collected compared to the losses that they're paying are disproportionate. They have to stay on their loss reserves, a cash amount of liquidity based upon their expected loss reserves. Each state department of insurance requires them to have an amount of cash on hand. They're all out of compliance. They could all lose their licenses. So the states, including Arizona, now altering these and changing these requirements to try and artificially keep them alive and keep them in good standing. We had 3-4 weeks ago, we had an ex-senior executive from Radian in our office. She was talking to us about other matters, and we had dinner and we talked. You know, they're just in a world of hurt. They are in a world of hurt. But at the end of the day, because I had to have the discussion with her, because I thought about suing the insurance companies for what we call bad faith. Under Arizona law, all insurance carriers have an obligation to give fair and equal consideration to the economic interests of the insured and themselves. Okay? So in my younger days, I used to do some of that work, and so it's not beyond me, the knowledge base, and so I had a lot of discussion with Radian on this. And I had this discussion with her, and she said, great argument, yes you do, yes you could, but we long ago figured out that you're not going to find a homeowner that wants to spend $100,000 in fees and 18 months in court only to win a case that says, okay, we acted in bad faith, and you've already lost the loss of economic betterment in the home. You know, the time, the energy, the effort, the cost, the expense, the risk, they've already calculated that no one's going to do it.
Except you.
I'm not going to do it. I'm not in a position where there's no ability to even do it on a contingency, right? And a homeowner can't pay it, doesn't make any economic sense. So as much as I rattle my saber, it's like throwing dust at the back of a full-grown rhino.